The dollar was supposed to be untouchable. Yet as the US-Iran-Israel war tears through the Middle East, it's not surging, it's stumbling. Oil has spiked, markets have buckled, and instead of rushing into the greenback, investors are dumping it, forcing an ugly, very real crash that has people asking whether this is the moment the dollar's aura of invincibility finally snapped. For decades, every big shock has told the same story. A terrorist attack, a global recession, a banking panic, a war. Pick your crisis, and the script doesn't change. Investors dump risky assets and sprint into dollars and US treasuries. The dollar rallies. Everyone declares its dominance unshakable. And predictions about its collapse look ridiculous all over again. That pattern is happening right now, too. As missiles fly, and the Strait of Hormuz looks more fragile by the day, the dollar is jumping against other currencies. Traders are treating it like the last safe room in a burning building. But here's the twist. That short-term strength may be masking long-term damage. This war probably isn't killing the dollar today. What it is doing is teaching the rest of the world, loudly, why they need to depend on it less tomorrow. Reserve currencies almost never die in a spectacular crash. They fade, one wave at a time, one decision at a time. The shoreline of their dominance erodes. Think of this conflict as another big wave hitting that shoreline. On the surface, the water slams in and then recedes, and everything looks the same. Underneath, the rocks are being carved away. In the heat of a war, fear still speaks dollar. Oil prices spike, shipping routes look risky, and investors reach for the most liquid asset they know. That still means the dollar, US treasuries, and dollar-denominated safe havens. So yes, in the early phase of a conflict like this, the dollar flexes. Emerging market currencies wobble, risk assets take a hit, and the greenback gets another short-term boost. If you only watch the charts, it looks like yet another victory lap for American money. But governments don't think like day traders. Traders are asking, what happens this week? States are asking, what happens over the next 10 years? And if you're sitting in Beijing, Riyadh, Ankara, Brasilia, Jakarta, Moscow, or even Berlin and Paris, you're watching this war and asking a much colder question. Do we really want our entire financial life wired through a system that Washington can weaponize whenever it decides we've crossed a line? Iran is the extreme case that proves the rule. The US didn't just sanction a few officials. It went after Iran's ability to move money, sell oil, insure ships, access SWIFT, and use its own dollar reserves. The message to Tehran was simple. We can lock you out of the global financial system whenever we choose. Iran had to improvise, selling oil through shadow routes, cutting deals outside the dollar, and leaning on buyers willing to operate in gray zones. Painful for Iran, yes, but incredibly educational for everybody else watching. Because if Washington can do that to Iran, it can do shades of the same thing to anyone it decides is a problem. That's not paranoia. Russia saw its central bank reserves frozen after the Ukraine invasion. Other countries noticed. Now zoom back out to the geography of this war. This isn't just some border skirmish. It's happening around one of the world's main energy arteries. The Persian Gulf and the Strait of Hormuz handle a huge chunk of global oil and gas flows. Every time a tanker is threatened, every time people whisper about Hormuz being blocked, governments don't just think about next month's fuel bill. they think about structural risk. They ask, who protects these sea lanes? Who sets the rules for insurance and shipping? Who controls the payment networks we use to settle these deals? And crucially, who can turn those systems off? For decades, the answer has been the United States and the US dollar. The petrodollar system locked that in. Oil was priced mostly in dollars. If you needed oil, you needed dollars. So you earned them, borrowed them, and held them in your reserves. That fed back into the demand for US debt, the strength of American financial markets, and Washington's ability to lean on that system when it wanted to. It was a beautifully self-reinforcing loop for America. But from the outside, that same loop can feel like a trap. The more Washington uses sanctions and financial pressure, the more other countries start hunting for exits. That's what de-dollarization really is. Not a dramatic overnight revolt, but a slow, practical move toward Plan B. It looks like settling more trade in local currencies instead of always defaulting to dollars. Central banks quietly trimming their treasury holdings and buying more gold. Oil and gas deals where part of the payment is in yuan, rupees, or euros. Building alternative payment systems so that if SWIFT or dollar clearing is ever blocked, money can still move. None of this makes headlines like dollar collapses, but put all these small moves together, and over time, the dollar's share of global reserves and trade flows starts to slip. Maybe not from first place to last, but from dominant to just one of several pillars. The current war accelerates that logic because it shows, once again, how tightly US military and sanctions power are bolted onto the dollar system. What used to be seen as a reassuring anchor is starting to look from outside like a single point of failure. If you're China, heavily dependent on Gulf energy and locked in a long-term rivalry with Washington, that's a nightmare scenario. No wonder Beijing has been pushing harder for yuan-denominated oil trade, more gold in its reserves, and more use of its own cross-border payment systems. And China isn't alone. Russia started dumping dollars from its reserves years ago and ramped that up after sanctions. Other emerging economies are diversifying too, not because they think the dollar vanishes tomorrow, but because they don't want to be as exposed if the next geopolitical shock hits them. Central banks buying gold at record levels, foreign reserves shifting away from US debt toward a wider mix of assets. That's all part of the same trend. Here's the irony. Every war that makes the dollar spike in the short term also reminds the world why it doesn't want to live in a world with only one safe asset. Yes, the dollar still has huge advantages. The US still runs the deepest, most liquid bond market. Its legal system is still more trusted than those of many competitors. There is no single currency ready to step in and fully replace it. The euro has political cracks, the yuan has capital controls, and gold, while solid, doesn't provide a full digital payment infrastructure. The dollar isn't about to be swapped out like an app on your phone. But that's not how this ends anyway. The real risk for the US isn't that the dollar falls off a cliff. It's that it slowly walks down the hill. A bit less of global reserves, a bit less of global trade invoiced in dollars, a bit less automatic demand for US debt. Over 10 or 20 years, that would still reshape America's place in the world. Borrowing might get more expensive, Sanctions might sting less. Do what we say or we cut you off might carry less weight. If you've watched this far, thank you. And if you want more breakdowns that connect wars, money, and power, hit subscribe, like and share this with someone who thinks the dollar is invincible. And tell me in one sentence what part of the global money system you want exposed next.